The $50 weekly investment that pays you $10,000 a month in 15 years cold, open you, direct to camera. $50 a week sounds like nothing, right? It's takeaway food. It's impulse Amazon buys. It's money you don't even remember spending. Whiteboard, $50 per week. Arrows to takeaway. Subscriptions. Random crap arrow into a trash can labeled gone. But if you point that same $50 at the right dividend growth strategy, it can start building a machine that aims to pay you over $10,000 every single month in about 15 years. Whiteboard, transform trash can into a machine. $50 in dividend machine. $10,000 per month, big red question mark. Sounds impossible. Stay with me, because in a few minutes I'll show you how one average guy, John, uses this exact $50 per week setup, and what his numbers could look like halfway versus year 15. Intro, click confirmation and contrarian. Take you. You click this video because $10,000 per month from $50 a week feels insane. Good. It should. You've been told you need a six-figure salary, a massive lump sum, or a high-risk gamble just to sniff that level of income. Whiteboard. Myth. Need big money to create big income. Underneath. Six-figure salary. Huge lump sum. Crazy risk. In this video, I'm going to reframe what $50 per week actually becomes over 15 years. Show you the dividend growth engine that turns small contributions into growing income. Walk you through John's 15-year plan. Expose the 3 mistakes that kill this for most people. This is not a magic trick. It's math plus discipline. And just to be clear, this video is education, not personal financial advice. And if you stay through the second half, you'll see exactly when this starts to feel real and when it can become life-changing. Section 1. Reframing $50 per week. Let's demolish the idea that $50 per week is nothing. $50 per week is $200 per month, $2,600 per year. Whiteboard, $50 per week equals $200 per month equals $2,600 per year. Draw timeline, years 1 to 15 with plus $2,600 added each year. Over 15 years, that's $2,600 times 15 equals $39,000 you either let evaporate or intentionally deploy. Whiteboard, under timeline, total contributions in 15 years approximately $39,000. Stack of cash labeled, your effort, $39,000. Most people never see that number because it leaks out in takeout, subscriptions, tiny upgrades, random I deserve this purchases. So here's the mental shift. Every $50 is not just small money. It's a seed. The seed is your $50. The tree is your portfolio. The fruit is your dividend income. Whiteboard. Draw a seed labeled $50 per week grows into a tree labeled portfolio fruit labeled dividends. Most people eat the seed. You're going to plant it. Section 2. The dividend growth engine. Before we plug this into John's real life, you need to understand the engine that makes this even remotely possible. If you get this part wrong, no 15-year plan will save you. So how does that little $50 seed become a serious income stream? First, we kill the number one beginner mistake. Beginners say, if a 4% dividend is good, a 12% dividend must be amazing. No. Whiteboard, 2 columns, left, high yield now, risky, can be cut, price can crash. Right, dividend growth, smaller now, grows over time, stronger businesses. High flashy yield often means The business is under pressure. The dividend might be unsustainable. Your capital might be at risk. For a 15-year plan, you want dividend growth, not just big yield today. You want dividend aristocrat-style companies, raising dividends year after year, dividend growth ETFs, baskets of those companies, diversified, focus on total return, price growth, plus dividend growth plus reinvested dividends. Whiteboard 3-layer. Total return engine, cake. Bottom, price growth. Middle, reinvested dividends drip. Top, annual dividend increases. Here's why this works. Your income grows as companies raise payouts. Your portfolio grows as share prices rise. Reinvested dividends buy more shares, multiplying the effect. This is not just income. This is an income engine. Section 3. John's 15-year plan. Let's make it concrete. Meet John. He's 30. Average job, average salary. No rich parents. But John is tired. Tired of feeling one bad month away from panic. Tired of working every month just to watch his money vanish. Tired of opening his banking app on Sunday night and wondering where his entire paycheck went? Again. So John makes a decision. From today, $50 a week belongs to future me. Whiteboard. John, age 30, $50 per week, dividend growth portfolio. Drip on. Draw John as a stick figure paying future me. John's portfolio structure. Here's how he sets it up. 50% into a broad dividend growth ETF. Lots of stable dividend growing companies. Built-in diversification. 25% into a high-quality dividend ETF with slightly higher yield. More income today. Still focused on quality. 25% into individual blue-chip dividend growth stocks. Businesses he actually understands. Long records of paying and raising dividends. Whiteboard, pie chart, 50% dividend growth ETF, 25% quality dividend ETF, 25% blue chip dividend stocks. Title, John's Dividend Engine. He invests $50 every week, around $200 per month, or $2,600 per year. Drip is on, so every dividend automatically buys more shares. Phase 1, the boring years, years 1 to 5. Early on, the portfolio value is mostly his contributions. Dividends are tiny. It feels slow. Whiteboard, simple table, year 1 to 5. Total contributed rising, portfolio value slightly above that, annual dividends starting small and creeping up. This is where most people say, this doesn't work. I've invested for 2 years and I'm getting peanuts. But that's like planting a tree and complaining after 6 months that you don't have a forest. John keeps going. Phase 2, the tipping point, years 6 to 10. By the middle years, the portfolio is doing more of the work. Dividends are now noticeable. Reinvested dividends buy more shares than in the early years. Whiteboard, same table, years 6 to 10. Portfolio value curve bending up faster. Annual dividends starting to stand out. John starts to realize in the beginning he carried the portfolio. Now the portfolio is starting to carry him. Meanwhile, his friend Mike is doing the opposite. Every dip scares him out of the market. Every rally makes him chase something new. 15 years later, they both invested, but only one of them owns an actual income engine. Whiteboard, 2 stick figures. John, same plan 15 years, versus Mike, panic, FOMO, no plan. He doesn't change the plan. He keeps feeding the engine $50 per week every week. Phase 3, the income years, years 11 to 15. By year 15, John has contributed around $39,000. The portfolio, depending on real-world returns, could be worth multiples of that. His annual dividends could now be a serious income stream. Could it be exactly $10,000 per month in pure dividends? That depends on actual returns, which no one can guarantee, how consistently he contributed, whether he avoided dumb mistakes like panic selling or yield chasing, how his allocation evolved. But here's the point. $50 per week plus 15 years plus dividend growth plus DRIP equals a realistic shot at life-changing passive income, not a fantasy. Whiteboard. Big call out. Key. Your income growth can surprise you more than your account balance. Section 4. Why most people never get there. You, slightly sharper tone. And here's the dangerous part. You don't have to do anything spectacularly wrong to ruin this. You just have to make the same 3 tiny mistakes everyone else makes. If the math is so powerful, why doesn't everyone do this? Because the problem is not the spreadsheet. The problem is behavior. Here's how people destroy this plan. Mistake number 1, stopping when the market drops. Market dips 20%. Headlines scream. Everyone talks about going to cash until it's safe. So they pause contributions or sell everything. Whiteboard, price chart dipping. Caption. Most people stop buying or sell. Big red X. Next to it, long-term investors. Keep buying. On sale. Green check. Those scary years are when you get the best deals. Stopping then is like refusing to shop when everything is on sale. If John bails in year 5 and waits until it feels safe, he doesn't just lose money, he kills his future income engine. Mistake number 2, turning off DRIP too early. At some point, dividends look juicy. A few hundred, then 1,000, then a few thousand per year. People think, nice, I'll start spending this. Whiteboard, drip on, more shares, more future income. Drip off too early, short-term cash, slower, long-term growth. Taking income later is fine, but during the growth phase, turning drip off early is like chopping down the tree when it finally starts producing fruit. Mistake number 3, shiny object syndrome. You see screenshots of crazy yields. Some random stock is paying 18%. Suddenly your boring 3 to 4% dividend growth ETF feels weak, so you dump your plan and chase that. Whiteboard, arrow from steady plan. Random 15% yield stock. Dividend cut. Price crash. Regret. This is how people ruin 8 to 10 years of discipline in one decision. The hardest part of this $50 per week plan isn't understanding it. You understand it now. The hardest part is being boring and consistent when everything online is screaming for you to react emotionally. Final T's and CTAU. So, can $50 per week really become $10,000 per month? In reality, your outcome depends on your time horizon, your actual returns, your discipline. But the real secret is this. The gap between no shot and a real shot is not a secret stock pick. It's whether your $50 per week disappears or gets deployed into an income engine for 15 plus years. Whiteboard. 2 boxes side by side. Left, $50 per week, spend gone. Right, $50 per week, invest growing income engine. Circle the right. This video isn't personal financial advice. It's a blueprint to test against your own situation and risk tolerance. If you're serious about testing this, your first real step is simple. Take the next $50 you were going to forget about and send it to future you instead. If you want to see actual portfolio examples, a conservative one, a balanced one, and a more aggressive one, and how each changes the time to $5,000 or $10,000 per month in dividends.